Have you ever watched a Forex trading video and you feel completely lost because of the terms Forex traders use? Terms like pips, leverage, lot size, margin, like you don't just get it. Well, in this video, I will be breaking down the most important Forex trading terms and languages for you to understand. No complicated explanation, no confusing language, just the exact explanation you need to understand how all these Forex trading terms reflect on the chart.
Hey guys, I'm sorry to stop your video. I'm so stressed. I shot this video at 3 minutes past 2 a.m. Yeah, so the time now is 3 minutes past 2. And I shot this video and it deleted. After I have edited and I was uploading it on my YouTube, the video deleted. I don't know what happened, but I just believe God knows best. So I had to come back after I've cried. I had to come back and shoot the video again. So this is past midnight and I just finished shooting now and I want to start editing. It's not really easy. Yeah. So I pray that the sacrifice that I have put into this very video, that you get to learn from the video and the video helps you to be profitable in your trading journey. Amen.
Hey friends, welcome to my YouTube channel. I am Emilienne Bejonen, aka FX Buddy, the self-life trader, and I always make Forex make sense. As you all know, in today's video, I will be breaking down all the Forex terms you've been hearing, the pips, stop loss, lot size, margin, equity, all of that. I'll be breaking it down so you can digest it and apply it on the chart. Do well to click the link in the description to join my free Forex community. Also click the link in the description to create your Forex trading account with a recommended broker, and do well to subscribe to my YouTube channel because you wouldn't want to miss a single video I drop on Forex education. Without further ado, let's get to class. The first Forex term we want to look at is a pip. Now, what is a pip? I bet you've been hearing about pips and pips. Now, a pip is the smallest price movement on the chart. It means each time the Forex market moves, it moves in pips. Just like how we can say we want to count from point A to point B, like you want to count how many steps you have moved. Whereas in the Forex market, the market moves in pips. Any step above is called a pip. So as you see the market rising up, the market is moving in pips, as simple as that. Example, let's say you want to buy your USD. It moves from 1.2000 to 1.2005, right? It means Euro USD has moved 5 pips. So the pip is usually the fourth decimal place. Still, if Euro USD moves from 1.2000 and goes to 1.2010, it has moved 10 pips, as simple as that. The next Forex term we want to talk about is lot size. Now, your lot size is your trading volume. It determines the amount of money you make or lose on a particular trade. Remember, the lot size determines the amount of money you make or lose on a particular trade, meaning the higher your lot size, the higher your profit, as well as the higher your losses if the trade goes against you. Same as the lower your lot size, the lower your profit, and the lower your losses if the trade goes against you. Perfect. Now we have 3 types of lot sizes. We have standard lot size. So the standard lot size ranges from lot size 1, and any number greater than 1. So 1, 2, 3, 4, 5, 50, 60, 100, all of those fall under standard lot size. The next type of lot size that we have is the mini lot size. So the mini lot size ranges from lot size 0.1 to 0.9, meaning any lot size within 0.1 to 0.9 is a mini lot size, meaning 0.1, 0.2, 0.3 up to 0.9, it falls under a mini lot size. The next type of lot size which we have is the smallest lot size, which is called the micro lot size. Now, the micro lot size ranges from lot size 0.01 to 0.09. Now, how are all of these lot sizes significant? Remember, we have said each lot size determines how much you make or lose in a particular trade. Now, using standard lot, right? If you are using standard lot size 1 and the market moves 1p, like the market goes ahead in your favor 1p, that is one move, you make $10. Same thing, if you are using standard lot size 2, the market moves in your direction 1p, you make $20, and so on and so forth. Using standard lot size 5, if the market moves in your direction 1p, you make $50. That's it, basically. Now, when we go to mini lot, remember, in as much as standard lot, as the market is going, you're making profit. If it's going against you, you're making losses as well. So for mini lot, remember, it ranges from 0.1 to 0.9. Now, it is expressed as using mini lot size 0.1. If the market moves 1p, you make $1. Using mini lot size 0.2, if the market moves 1p, you make $2. Same as if the market is going 1p against you, you are losing $1. As simple as that. Same as if you are using mini lot size 0.8, if the market goes in your favor 1p, you make $8. So for every p, you make $8 using mini lot size 0.8. So your lot size tells you how much you will make or lose in a particular trade. And the last type of lot size that we have is the micro lot. Now the micro lot, we have said the bracket is 0.01 to 0.09. So using micro lot size 0.01, if the market goes in the direction 1p, you make 10 cents. Make little money, just 10 cents. Using micro lot size 0.2, if the market goes in the direction 1p, you make 20 cents. Now mind you, we deal in dollars, not in cents. So it takes 100 cents to make $1. 100 cents make $1. So while trader A is making $10 per pip using standard lot size 1, trader B is making $1 per pip using mini lot size 0.1. Trader C with a small account is making 10 cents per pip using micro lot size 0.1. So that's everything you need to know about lot sizes. I have done a detailed video explaining about lot sizes and which exact lot size to use on a particular account. If you have a large account, I have specified which lot size you should use. If you have a small account that you're trying to grow, I have specified in the video which lot size to use. So after this video, you can check on my channel to watch the video on lot sizes. Let's continue with class. I hope you are learning so far. Don't forget to click the subscription button, share this video, like, drop a comment, and link in the description to join my free Forex community where I share my setups and empower traders. Also, click the link in the description to create your Forex trading account. Let's get to class. The next Forex term we want to look at is leverage. Now, in plain English, leverage means take advantage of, take opportunity, right? Now, in Forex context, leverage allows traders to control larger investment with small capital. So leverage gives traders the opportunity to control larger investment, like larger capital, with their small account sizes. Now, how does this actually apply? Imagine you have a $100 account. After learning, you know how to trade very well, but you can only afford to deposit $100 to start trading. Now, with that $100, mind you, you cannot use standard lot. You cannot even use mini lot sizes because you will be over risking. Now, the broker gives you leverage. The broker can choose to give you leverage of 1:100. Now, if the broker gives you a leverage of 1:100, it means you can make 100 times what you have in your account. It means with your $100 account, the 1 represents your account balance, which is $100, is to means multiplication and multiplied by the 100 leverage. Now that automatically gives you a $10,000 account. So with your $100 account and a leverage of 1:100, it automatically means you are controlling a $10,000 account. It means you can use standard lot sizes. You can share lot size 2, lot size 3, lot size 1. You can use mini lot, micro lot, and standard lot, right? Which is positive, which is good. You can make more money, especially on your A+ setup. But leverage is a two-way sword. In as much as it could make you money when you take advantage of it, if the trade goes against you, your account is finished, your account is broke, your account is finished. So it is important for us to use leverage, but then use it wisely. Do not over leverage because you end up blowing your account. Next Forex that we want to look at is equity. Now, equity simply means the sum of your account balance plus any unrealized profit or loss. So equity means your account balance. Let's say you have an account balance of $100. Then you have placed a trade and the trade is running in profit. The trade is running in profit of, let's say, $20, right? The equity section on your empty file would show $120. That's it. So it's just the sum of your account balance plus any unrealized profit or loss. Same as if that trade that you took was running in a loss of $20, your equity will show $80, which means your account balance minus the loss that you are running on. So that's what equity basically means. The next key concept we want to look at is very, very important. Stop loss in bracket SL. Stop loss in bracket SL. Never trade without a stop loss. My brother and my sisters, never trade without a stop loss. If you want to cry, if you want to buy, try it. So as a professional trader, as somebody who is looking to excel in trading, never trade without stop loss. Now take this down. A stop loss is an order that is set to automatically close a trade at a predetermined price to avoid further losses. Losses are inevitable, yes, but we can avoid it, we can mitigate it, we can reduce losses. So that is why stop loss exists in trading. So it helps us to close a trade at a predetermined level to avoid further losses. Now imagine you want to buy, right? You want to buy, price has bought, it has gone up, but then you are not present to close your trade. Now price starts dropping back down, price drops down, and there is no breaks. So stop loss is like a brakes. You're driving a car, now you need a brake to avoid accident. So you're setting that particular stop loss that if I want to buy, but the market later on sells down, it should close me at this price. Now let's say you wanted to reach just $20 on that trade. It means stop loss price will be $20 worth. When price sells and hits $20 loss, it will automatically close you. You still have balance money in your account that you can use and trade. As simple as that. So we should always set stop loss. Now if you want to buy, stop loss should be set below, right? If you want to buy, stop loss should be set below, and if you want to sell, stop loss should be set above, so that if you're selling, the price starts buying up, it should close you at your stop loss price. As simple as that. Now you avoid blowing your account. Most traders who cry over losses too much, they are traders who do not know about stop loss. They are traders who know about stop loss, but they don't place stop loss. So don't be that trader. Great. The next key concept we want to look at is take profit, in bracket TP. Just as how stop loss makes traders to cry, to weep, TP makes traders happy, like excited, fun, joy. Great. Now, write this down. Take profit is an order that is set to automatically close a trade at a predetermined price to secure profit. It's very important that we set TP, because there are times in the market that you might want to buy, price buys and goes up. Maybe you're busy, you're cooking, you're at work, you're working out and stuff like that. So you cannot manually close the trade. Now the trade has bought, it has run in so many pips profit, but you're not present to close it. Now it goes up, gets to a resistance level and start dropping back down. That's you losing back all your profit. So it might drop. If you don't have stop loss there again, it might wipe everything out of your account. So it's important that we set a TP. So if we want to buy, stop loss should be set below and TP above, because we are buying targeting level above. While if we want to sell, stop loss should be set above and TP below, because we are selling from up, targeting a price down. As simple as that. So a perfect trade is a trade with TP and stop loss set perfectly. The next key concept we want to look at is liquidity. You must have heard about liquidity, right? Hey, gold has liquidity, the Forex market has liquidity, blah blah blah. Now what is liquidity? In simple terms, liquidity means availability of money, availability of cash, right? That's money in the market. So as we all know, the Forex market is the largest financial market in the whole world, running trillions of dollars daily, right? So the trillions of dollars that the market runs daily means high liquidity. It means there's money in the market giving you an opportunity to actually trade it. So that's what liquidity means. It means money in the market, right? Gold has high liquidity because there are lots of buyers and sellers in that market. So there's plenty money in that market. The next key concept we want to look at is volatility. Now, volatility means movement in the market. It means the market is going up, it's going down, it's going up, it's going down. Like the market is moving. And when the market moves, the market is moving because of liquidity. Because if there's no money, the market will not move. Buyers will not push it up, sellers will not send it back down. So volatility simply means movement in the market. As simple as that. Now, the next key concept we want to look at is bullish. Bullish is another name for buy. Bullish means we want to buy. It means we have seen the buy opportunity. Now, if you don't want to call it bullish, you can call it buy. You can call it uptrend. You can call it long. Because if you want to go long, or you call it ask price. So ask price is the price you want to buy at. If you don't call it bullish, you can call it uptrend, you can call it buy, you can call it long, or you call it the ask price. It just means you want to buy. These are all that means that you can call buy. The next key concept we want to look at is bearish. Now bearish means we want to sell, we want to go down. So if you don't call it bearish, you can call it sell, you can call it a downtrend, you can call it short. You want to go short, good. So you call it bid price. So bid price is the price we want to sell at. As simple as that. So these are just all that means to address the downtrend market, the sell, right? The short. Those are all names to call sell, basically. If you are learning a lot from this video, do well to click the link in the description to join my free Forex community so you never miss any of my excellent setup. Also, you will find in the description link to create your Forex trading account with a recommended broker. Do well to like this video, share and comment. The next Forex trading term we want to look at is a currency pair. So a currency pair is basically two currencies traded against each other. A currency pair is a combination of currencies. Two currencies coming together and being traded against each other. One currency is buying and the other is selling. Or one is selling and the other is buying simultaneously. That's how the Forex market works. So we can have a currency pair like Euro, USD. That's the Euro traded against the United States dollar. One of it is buying and the other is selling. Both of them cannot buy at the same time. Both of them cannot sell at the same time. The next example, we have USD CAD, the United States dollar traded with the Canadian dollar. One of them buys and the other sells, or one sells and the other buys. As simple as that. The next key concept we want to look at is a broker. This is very important. So this is the broker I recommend. Business, reputable, reliable, credible, a regulated broker, the best. Now, who is a broker? A broker is an institution, a company, an organization, whichever way you want to put it, right? That gives us access to the forex market, that gives us direct access to the $9.7 trillion market, right? So when we place the buy or the sell, Business sends it directly to the $1 trillion forex market. That is why we have opportunities in the market, right? That is why we have opportunities in the forex market. So the broker is any organization that gives us access to trade the forex market. And now the broker gives you opportunity to create your forex trading account and you trade the forex market. As simple as that. And it is free, completely free. So the link in the description is the link to create your forex trading account with your recommended broker, Business. The next key concept we want to look at is trend or trend line. So the trend simply tells us how the forex market moves. And the forex market moves in three ways: either uptrend, downtrend, or it ranges. Now, contextualizing this in trading, the trend tells us the overall direction of the market. So the trend line tells us the overall direction of the market. And we have three types of trend line. We have the uptrend or the ascending trend line. That is, the market is going up. Or we have the downtrend, that is the descending trend line, the bearish trend line, which means the market is selling down, the market is going down. Or we have the horizontal trend line, which means a ranging market, just resistance, support, price is just ranging within it. That's basically it for trend lines. The next key concept we want to look at is candlestick. Now, you see lots of candlestick on the chart. When you open your forex chart, you see many candlesticks, right? Now, all these candles tells us one thing: who is in control of the market. So a candlestick is price representation or price movement on the chart. Candlestick move alongside the pips because these pips, they move in candlestick. A combination of pips will form a candle, and we have different types of candles in the forex market. So we have mainly two. You either see a blue candle, or a blue candle can still be seen as a green candle, which means a buy candle, a bullish candle, a long candle, right? Or you see a red candle. The red means sell candle, short candle, right? Bearish candle. So those are the two colors you see on the chart. Now, a typical sell candle looks like this, and every candle has the open price, close price, has the body, has the high price and the low price. So every candle has all these parts. High price, that is the highest level price has reached. The low price, the lowest level price has reached. The open price, normally candles open, when we are selling, we are expecting the market to drop down. So candles open so the sell candles open from top and then close at the bottom. As simple as that. A typical buy candle, bullish candle looks like this. Same thing, it has the high price, the low price, the body, the open and the close price. Same thing, if we are buying, we are expecting the market to leave from low and rise up. So the buys open from below, the open price is below and the close price is above. As simple as that. I have also done a detailed video on understanding candlestick, because every candlestick on this chart, you see them having different sizes, different shapes. They all mean different things. So I have done a detailed video explaining candlesticks, which exact candle do you need to see before you have that perfect entry confirmation. So you can watch it on my page after this. Don't forget to drop a comment for me, because I always make Forex make sense in the simplest way. The next key concept we want to look at is support. Now, think of support as the floor level, a level that price has dropped to but cannot break it. So at support, price rises back up. So at support, we traders know that when price is at a support level, we should be looking for buy opportunities. As simple as that. The next, we have resistance. Resistance is, think of it as a ceiling level, a level that price has gone up to, cannot easily break. Price has gone up to resistance, cannot easily break it. So at the resistance level, price starts dropping back down. At resistance, we traders know that we should be looking for sell opportunities, because price will not easily break resistance. As simple as that. I have done a detailed video on understanding support and resistance and knowing when to take that perfect entry. Same thing, video on my channel. Do have to subscribe and watch it after this and drop an amazing comment for me, because trust me, you understand it perfectly. Next key concept we want to talk about is breakout. So breakout means high price movement, right? Strong price movement in the opposite direction. So breakout, it could be a breakout from an uptrend. Breaking out from an uptrend means price was going up, but then there was a breakout, a strong price movement changing the trend to make it a downtrend. It could be a breakout from a resistance level. Maybe price was buying, it got to this resistance level and finally broke it all. So that is a breakout. Now, when price breaks out from a resistance level, the resistance becomes support and we buy from that support. Same as when price breaks out from a support level, the floor level, when price breaks out from a support level, this support becomes resistance, the new resistance level, and we sell from it. So strong price movement. So breakout means price is breaking out to another direction. As simple as that. The next key concept we want to look at is risk management, which is very, very important. Strategy can be good, but risk management is better. So you can have strategy, then you mix it with your risk management. Trust me, you'll be a profitable trader. Now, risk management is simply the ability to trade without blowing your Forex trading account. The ability to trade every day. You wake up every day, you have capital that you trade, you have capital that you are growing gradually. So that's what risk management is. Now, risk management entails so many other things like stop loss, take profit, risk per trade. Now, risk per trade tells you how much you want to risk on your account per trade, right? And it's advised that for a live account, you can risk 1 to 2% per trade, and for a prop firm, you can risk 0.5% to 1% per trade, and you can take maximum 3 trades per day. That's a good risk management advice. But there are times that you will not see any trade. So sometimes no trade is the best trade. Also, we want to look at risk to reward ratio. That's another aspect of managing your risks. So risk to reward ratio tells you how much you are risking versus how much you are aiming to get. It's advised that we always aim for 1:2 or 1:3 per trade. It means if you're risking $20, you're hoping to get $60 or $40, meaning you have had profit on that trade. So risk to reward is very, very important. If you're risking $10 per trade, you should be targeting $20 or $40 return. As simple as that. And the last key concept we want to look at is retest. Unlike breakout, which means strong price strong price movement in the opposite direction. Retest means a bounce, then it moves in the same direction. Now, same thing, if a resistance level breaks, it will not just easily break like that. So it will break up, then it will retest it again before rising. So retest is like a validation, like it wants to validate that particular level before it moves. Same, if a support level breaks, it will break down, but there will be a short retest back at the level, but then it will continue dropping. So it's important that we understand all these terms and how they are applicable on the chart. Next key concept we want to look at is spread. Now, spread is simply the commission we pay to the broker for giving us access to trade the forex market. That's all. It is the difference between the ask and the bid price. Remember, the ask price is the price we want to buy at, and bid price is the price we want to sell at. So the difference between the ask and the bid price is what is referred to as spread. Now, oftentimes, if you have been trading, you notice that when you press a buy, even if that trade is a profitable trade, it will run in little losses before it starts running in profit. Now, that little red is the spread that you have paid, and using the Xness broker, you might not even notice it because Xness offers very tight spread, very low spread that you will not even notice. It means you are paying little or nothing to trade the forex market. So we should go for brokers like Xness that offer us very tight spread, very low spread, because it makes us more and more profitable. If you hear any broker saying wide spread, avoid it too. So link in the description to create your forex trading account with the recommended broker Xness and benefit from their tight and very low spreads. Forex become more easier when you understand the language traders use every day. So we have come to the end of today's video. Hope you learned a lot from it. Do well to comment everything that you learned from this video. If there's any term that I missed, drop it in the comments, and in the next video I'll drop it for you. If there's any topic that you find complicated, drop it in the comments and I'll do another video explaining that particular topic for you to understand. You know, I am a Forex bestie and I just want to grow you. Link in bio to join my free Forex community. Link in bio to create your Forex trading account with a recommended broker. And I'll see you inside. Bye. See you in the next video.